Hello, everyone, and welcome to our latest edition of our first time buyer, our Home Buyer Masterclass. I'm excited tonight because we're going to get into a couple of new topics that we haven't discussed before. And if you ever want to go back and check previous webinars that we've done, we do have a YouTube channel, Home Buyer University with KJ the Closer. That's me, KJ the Closer, Ken Jordan with Princeton Mortgage, where we're going to house all of our previous home buyer education courses. Now, I know a lot of these classes are recordings, believe it or not. You know, when you sign up for some of these webinars, you're basically just getting the same recording that's running every hour on the hour. And, you know, maybe there's some value to that. Maybe. But the reality is, I like to think that there's value in real time information. And to prove it, I'm going to tell you the Phillies just swept the Padres, and that proves that today is the day, and this is a live webinar. One of the things we're going to get into today is the how to buy before you sell. I know a lot of the information we're going to be sharing with you is going to be incredibly valuable to first-time buyers, but there's a piece of information as we get into the underwriting that I think is going to be important to people who have a home that are looking to sell their home. And how can they do so confidently? How can they put together a strong offer? And how can they do so without a home sale contingency, which home sale contingencies essentially state, I want to buy your house, but I can't because I have a house to sell. But if you give me a chance to sell my house, I'll buy your house. Well, most first-time buyers don't have that. Second-time buyers, it's a struggle right now. So we're going to get into that as well. So note that we do have a chat. If you have any questions, please don't hesitate to. I'll be looking to my right here to see if anyone has any questions in the chat. So by all means, please do not hesitate to throw a question there if you have one, and if it catches my eye, I'll answer it. But also, I'll be taking questions towards the end. So again, as I said before, my name is Ken Jordan. I'm with Princeton Mortgage. I'm in the mortgage business for 24 years, helping primarily first-time buyers since the beginning of my career. You know, I got in the mortgage business when I was 22 years old, and I looked like I was 16, and the struggle was real. But I was able to really learn the business from a first-time buyer's perspective, from a young borrower's perspective, and it allowed me to really cater my business to helping people uncover answers. And even as a second time or a third time buyer, when you approach the process the correct way, we can really make sure that you're prepared and that there's no problems. And then one of the things I always say is proper preparation prevents problems. You're going to hear me say that a couple times today. So I'm going to start by going ahead and sharing my screen. And from there, let's see, it's going to be screen 2. I have 5 of them. I know that's kind of crazy. Screen 2. From there, you're going to be able to see our screen. So hopefully everybody can see my screen. If you could throw a thumbs up in the chat. I'm the only one that can see your questions. I'm the only one that can see your comments. But if you throw a thumbs up in the chat, it's great because it doesn't make me feel like I'm talking into an empty room. This is an interesting concept because I can't see anyone's faces. But at the same time, I can interact if you'd like to interact. And it helps me to kind of stay dialed in. So by all means, interact, throw me a thumbs up, say hello, tell me where you're from, and we'll have some fun here today. So let's first start with, you know, why buying your first home can be a little bit of a struggle, and it's because it's a maze. That's really what it is. There's so many questions, and there's so many big questions. There's so many important little questions too. But the first big question is, what can I afford? Okay, well, we're going to answer that question today. I'm going to show you not only how do we determine what you can afford as a first-time buyer, I'm also going to share with you a really cool tool, a calculator that you'll get that can help you to really dial in on what your monthly payment and your cash out of pocket might be on a given house, on a specific house. How much cash do I need? What a tough question to answer. There's so many ways to answer that question. Down payment, how much are you going to put down? 3%, 5%? You know, what are the taxes? What program? What sale price? Like, you know, all of that really plays into how much cash you're going to need. And how do I win the house? We're going to talk about some of that stuff today. In most markets right now, especially in the Pennsylvania, Delaware, New Jersey market where I am primarily. I'm also licensed in Florida. The housing market is still very, very competitive, very competitive. So you want to make sure that you're putting together an offer that's going to win. That's the bottom line. Okay. And we're going to answer these questions today. But what buyers really want to know, other than the obvious, what can I afford? What's a strong pre-approval? Can I use gift funds? What does my payment include? How much cash do I need? Should I put more money down? How fast can I write an offer? We're going to get into all of that today. And by the time we're done, you guys are going to have a much clearer picture of what the road ahead is going to look like. So again, I'm just checking over here, making sure that, I'm hitting, hey, Bob, just hitting my my chat room to make sure I'm not missing anybody. Now, the first thing, and this is something that's important to me because I feel like buying a house is an accomplishment. It really, really is. And anything in life, when you set a goal, okay, you can't just have a goal. You have to have a reason, a why. Why do you want that thing, right? Whether it's simply, running a marathon or losing weight or, getting a good grade on an exam or, improving your mile time. These are all goals, and goals are great. But if you don't have a why attached to that goal, then a lot of times things that get inconvenient will get in the way. So what are some of the surface reasons why people want to own a home? Well, how about more space? Maybe you had a third child and you only have 2 bedrooms. Now, I grew up in a house, 4 boys, 3 bedrooms. There were 2 of us in one bedroom, 2 of us in the other bedroom. And every night was World War III. That's you could ask my brothers and, of course, my mom, who was a saint, raising 4 boys in a 3-bedroom house. It was not easy. That's why we put 2 more bedrooms in the basement. Better schools is another reason why someone might want to move. A yard, privacy, stop renting. But there are deeper motivations. And these are really, kind of core reasons why owning a home can be so life-changing. One, stability, right? Your landlord can't sell the house out from under you. Controlling what you can do to the house. Pride, right? Responsibility is the precursor to purpose. Security, community, being part of something, taking care of your house and having your neighbors taking care of their houses and taking care of each other is a big part of a neighborhood and a community. And of course, legacy, being able to pass down wealth, generational wealth to your children. Most Americans' generational wealth comes from real estate. So that being said, those are some deeper motivations. The bottom line is you're not buying walls, you're building a life. And I hope that resonates with some of you. If it does, go ahead and throw your hand up in the chat and understand that these conversations are not just about putting a roof over your head. There's a deeper motivation. I'm going to move this out of the way so you guys can see that. Okay. Now, let's jump into the mortgage application. Okay. Obviously, before you can buy a house, you have to be able to finance the house. Before you can finance the house, you have to be able to get a mortgage. And before any of that, before you even see the first house, you have to understand what is it that the underwriters are going to be looking for in a mortgage application. Now, I picture a triangle, okay? The mortgage application is designed to fill in the gaps around 3 primary areas of risk, okay? The first is credit score. Now, credit is a numerical representation of how well debts have been managed over the last couple of years. It's not who you are. It's a score. It's basically just a representation of how well debts have been managed. Now, what's a good credit score? Well, of course, a good credit score is something in the 800s. 850 is the max. Once a year, twice a year, I might see someone who has 3 scores that are above 800. Okay. You have 3 scores, and the mortgage company is going to go off the middle of the 3. Okay. So if you have a 720, a 715, and a 700, we're going to go off of the 715. The scoring decision is going to be made off of the 715. What goes into your credit score? Well, a number of things. What type of debt do you have? Credit cards, student loans, car payments, mortgages, other revolving debt, department store charge cards. These are all types of debt. And the type of debt that you manage changes your score. Some debt carries more weight than others when it comes to the scoring model. How much you're borrowing versus the limits on your cards. We call this utilization rate. Utilization rate is if you have a $10,000 limit on a Visa card and you're borrowing $2,000, that's a 20% utilization rate. It's also a very good utilization rate. $9,000 on a $10,000 limit, now you're at a 90% utilization rate. And a 90% utilization rate, even if you're paying your bills on time, a 90% utilization rate can actually hurt your scores, okay? How long you've had debt is another thing that plays into your credit score. If you have one credit card, it's your first credit card, there's a chance that even if you're paying it on time, your score might not be that high. You build it up, you borrow money multiple ways, and slowly your scores do come up. And then how much debt? We call these thin credit files, or maybe you only have one department store charge card. And there are programs out there for no credit score, thin credit score, and of course, good credit scores. So that's how, for one of the first things the mortgage company is going to do is they're going to want to take a look at your credit report because it's going to answer as many questions as we need with regard to whether or not you can get a mortgage. Now, how much of a mortgage and what program you're getting into, that remains to be seen. But whether or not you can get a mortgage is going to be driven off of primarily off of your credit score. Now, the second piece, I'm going to bounce back and forth here a little bit, is income. And when we talk about income, really we have to look at a couple things, not just your real income, but also your qualifying income. Now, what is real income? Real income is every penny that comes in the door. It's your base pay, your bonus, your overtime, your commissions. It's everything that helps you pay the bills. What goes into savings, what goes into investments, what pays the bills. That's real income, okay? Qualifying income is income that we deem reliable moving forward, okay? Income that we deem reliable moving forward. How do we determine if an income stream is reliable moving forward? Well, we look at the past. That's really all we have to go off of. How much did you make last year and how much did you make the year before? Now, keep in mind, we look at income in streams. So your base pay, that's an income stream. Your bonuses, that's an income stream. Your commissions, that's an income stream. Side work, that's an income stream. Part-time job, that's an income stream. Social Security, that's an income stream. And we look at each income stream individually, and what we're looking for is a likelihood of continuance. Now, for most income streams, we're going to require at least a 2-year history so that we can average it out to determine what your average income is over those 2 years. But let's say you're salaried and you get a raise. We're not going to average out your raise. We're basically going to look at your salary at face value, and that's going to be your qualifying income for salary. If you happen to get bonuses on top of that, we're going to look at 2 years history for that bonus. If you happen to get commission on top of that, we're going to look at a 2-year history for that commission in order for it to be considered qualifying income. There's some situations where maybe not necessarily needs to be 2 years, but 2 years is definitely the rule of thumb. Now, once we determine what your qualifying income number is, in this case, we're going to use super easy numbers. Let's say $10,000 a month. Gross qualifying income, that's before taxes. From there, we're going to apply a percentage to it. That percentage is known as a back-end ratio. Yes, your qualifying income is off of your gross, not off of your net, okay? Now, once we apply that percentage, okay, in this case, let's just use 45% as our starting point because that's kind of the max in a lot of programs. 45% of your gross monthly qualifying income can be used towards your debt. So in the case that we're using the $10,000, $4,500 will become what we call your debt threshold. Your debt threshold, meaning all of your debt, your current mortgage payment, if you have one, your new mortgage payment, and of course, your student loans, credit cards, car payments. All of that cannot exceed, in this case, 45% of your gross monthly qualifying income. Now, do we have situations where we can go above 45%? Yes. But in this case, we're going to stick with the 45%. So if $4,500 is your max monthly payment, if we strip away your credit cards, your car payment, your student loans, what we're left with is how much you can afford in a mortgage payment. And that's how we determine what you qualify for from a monthly payment perspective. Now, what goes into your mortgage payment? Well, a bunch of stuff, to be honest. Principal, interest, taxes, insurance, MI, and of course, HOA. Now, the terminology we use is PITI, principal, interest, taxes, and insurance. Mortgage insurance is an insurance, so it's included in that. Let's talk about mortgage insurance for a quick minute. When would someone be required to pay mortgage insurance? Well, if you're putting down less than 20% in most cases, you're going to be required to obtain a mortgage insurance policy. Now, the mortgage company will pick the mortgage insurance company. Typically, there's a pricing engine where we'll obtain the mortgage insurance company that's going to give us the lowest premium for your particular situation. That insurance premium or that insurance policy insures the lender. It insures the lender for the 20% that's not getting put down. So let's say you're putting 5% down. The mortgage insurance policy is going to insure the other 15%. If you're putting 3% down, the mortgage insurance policy is going to insure the other 17%. If you're putting 15% down, then the mortgage insurance policy is only going to cover the remaining 5%. So as you can imagine, the amount you put down is going to drive your mortgage insurance. And about 10 or so years ago, we started to see mortgage insurance based on credit scores as well. It used to be just strictly based on loan to value ratio, how much you're putting down versus how much you're buying the house for. Now, credit score plays a role, which means that if you have really, really good credit, even if you're putting 5% down, mortgage insurance is not that expensive. So that's my piece on mortgage insurance. I know it gets a bad rap, but what it does is it allows you to buy a house with less than 20% down. And generations ago, that was the only option, was 20% down. And believe it or not, some people still think you need 20% to put down in order to qualify. And you don't, thanks to mortgage insurance. Okay? So your PITI has to, it adds up to your total mortgage payment. So let's go back to our monthly payment scenario. $10,000 a month in gross qualifying income. That means you're going to borrow $4,500 per month. Excuse me, your debt threshold is $4,500 per month. From there, we're going to take out what you're already borrowing. So let's say you have a $500 car payment. That brings us down to $4,000. And let's say between your credit cards and your student loans, another $500. That brings us down to $3,500. That $3,500 has to include your principal, interest, taxes, and insurance. All right. Now, let's move over to the third point on that triangle, the third area that we have to look at, and that's going to be cash to close. Most people, I get the question all the time, how much money do I need to close? Well, that is a moving target. Again, like I talked about, how much are we putting down? What are the taxes? What program are you using? But what I can tell you is there's going to be three components to your cash out of pocket number. Okay. Number one is down payment. For first-time buyers, they're going to be eligible to put down as low as 3%. For veterans, they could put down as low as 0%. If you're buying using a USDA, what we call rural housing, which in some areas, in rural areas like in Chester County, Lancaster County, Berks County, some in New Jersey, you have areas that are rural where you can put as little as 0% down. The down payment is the first component, whether it's 3, 0, 5% down, 15% down, whatever it is. That's the first component. The second is what we call non-recurring closing costs. What are non-recurring closing costs? Well, non-recurring closing costs are going to be your transfer tax, your title insurance, your lender fees, your recording fees. These are things that you only pay. Let me rephrase that. These are things that you pay, but you only pay them one time. You don't pay them again for as long as you're in that loan. say that loan, not that house, because if you refinance, some of those closing costs are going to be on the refinance. But assuming you don't refinance, it's a one-time thing. Now you have your prepaids and your escrows, okay? You're going to be required to pay 12 months worth of real estate taxes in PA and in Delaware. In New Jersey, taxes are paid quarterly, so maybe you only need to pay 3 or 5 months worth of taxes in New Jersey. And you're going to have to pay your first year's homeowners insurance premium up front. That's included in your closing costs. Now, in your mortgage payment, remember what it was made up of: PITI, principal, interest, taxes, and insurance. Every month, a little bit of money from your mortgage payment is going to go into what's called an escrow account. In that escrow account is going to be the money for the homeowner's insurance and the money for the taxes. When those tax bills come due, the mortgage company or the servicer pays those bills out of the escrow account. So you always pay a little bit, you pay a portion of the taxes at settlement, and then you establish your escrow account and you continue to fund that escrow account each month. And when the tax bill comes due, they have enough money to pay the account. That's your total cash out of pocket. That's how much money you need to close. We're going to talk a little bit about some ways we can really lower that cash out of pocket. Okay. Now, let's say we go through your credit, you're in great shape. We go through your assets, you have the money to close. And we go through your income and you qualify, you qualify for that payment. What separates you from anyone else that qualifies for a mortgage when you're getting ready to put an offer? Number one is a strong pre-approval. Now, one of the things that we do here at Princeton, I know we're not the only company that does it, but I know a lot of companies don't, is something called a TBD underwrite. A TBD underwrite means not only are we going to ask you what you make, ask you what you have in the bank, which any online application will do. We're actually going to request the documentation or use electronic validation tools to verify that information so that we can then put your file in front of an underwriter and have them sign off on your income, your assets, and your credit. The only thing left to do is find a house and get insurance. A strong TBD underwrite, or pre-commitment we call it, when a listing agent sees that, and I've had listing agents on these webinars before raise their hand and say, absolutely. When a listing agent sees that your file's been fully underwritten, they're going to point to that offer when they're presenting to the seller, and they're going to say, look, this borrower's already been underwritten. Fewer problems. Proper preparation prevents problems. They want an effortless mortgage just like you do. So they're going to look at that, and that is absolutely going to carry weight. Do you need a fully underwritten pre-approval? Of course not. A regular pre-approval letter will do. But if you do the work, you do the legwork ahead of time, a fully underwritten pre-approval is going to really, really help. Clean documentation. Sometimes we ask for pay stubs, W-2s, bank statements. I like to call it the 222. 2 pay stubs, 2 W-2s, 2 bank statements. Sometimes we get 1 W-2. Sometimes we get a pay stub that's got chewing gum on it. Sometimes we get pay stub from the previous year. Pay attention to the documentation, okay? Pay attention to the documentation. That's where we're going to make sure that the fully underwritten pre-approval is clean, okay? Keeping your stuff organized. Realistic cash to close, and I'm also going to say realistic time to close, okay? What makes your offer strong, okay? If you're putting 20% down, that's certainly going to look better than 3% down. But if you can document that you have the assets through your BFI and through your fully underwritten pre-approval, that becomes less of an issue. Time to close. Today is May 27th. We took an application today for a buyer who went under contract yesterday, and they're closing on June 22nd. Now, to a lot of companies, that's very difficult to close. It's very, very difficult for a company to close in less than 30 days. There's some good ones out there. We're going to get that closed because we do the legwork ahead of time. And the borrower won that bid because they were able to close quickly. Okay. They were able to close quickly. Being aggressive on your timeline for the seller is one way to really help your offer stand out, even if there's another offer with a higher sale price. You show up fully underwritten, ready to go, aggressive close times, that's going to really stand out. Some of the other borrowers might have home sale contingencies, and that's where we're going to get into here in a second, but I'm going to finish with clear communication with the listing agent. One of the things that we do here at Princeton, or my team anyway, is we reach out to the listing agent when you put your offer in. Why? Well, again, listing agent wants an effortless process. When you speak to the listing agent and you're able to give them the confidence that they need to accept the offer, what are the type of things that we talk about in that conversation? Well, we can't get specific, right? Because obviously, they're not entitled to your financial information. But what are they entitled to? Listen, these buyers have been very responsive. These buyers have already provided all the documentation that we need. This credit report doesn't expire for another 90 days. A good listing agent is going to ask these questions. Was the file already put through an automated underwriting engine called Desktop Underwriter and Loan Prospector? These are automated underwriting engines that we run the files through. Good listing agents will ask these questions. My ability to say yes is what's going to help your offer also stand out. So let's talk about, we talked about the fully underwritten pre-approval, the seller confidence. I want to go back. I want to talk about the home sale contingency. What is a home sale contingency? Well, a home sale contingency is when you want to buy a house, but you have a house to sell. Okay. That presents two distinct problems. Number one, do you qualify carrying both mortgages for the house you're looking to buy and the house you're looking to sell? Now, that doesn't mean you're going to carry both mortgages. It's just, do you qualify carrying both mortgages? And if the answer is no, then we have an issue. We have a debt to income issue, right? All of your debt exceeds that debt threshold if we have to count your current mortgage payment. The second is, where's your money coming from for closing? Is it tied up in equity on the house that you're looking to sell? And if the answer is yes, my assets are tied up in my equity. And if the answer is no, I don't qualify carrying both mortgages, that presents a problem. You need to put your offer in with what's called a home sale contingency, meaning this offer is contingent. My ability to close, my ability to buy your house is contingent upon obtaining a buyer and selling my house. Now, what we do here at Princeton, we have a great buy before you sell program. One aspect of it is what we call the DTI drop. That's where we will get and give you a cash backup offer for your house. Well, what does that do? Well, if you have a cash offer on your house, that means that we don't have to count your current mortgage payment against you on the new mortgage. We call that the DTI drop. Cash offer on your house. Now, it's not a cash offer like they're going to buy your house. It's called a cash backup offer, meaning that you're still going to sell your house to whoever you're going to sell your house to. And maybe that house is going to settle prior to the purchase of the new house, or maybe it's going to settle 10, 15, 30, 60 days after you purchase the house. But the bottom line is, we're going to be able to qualify you on the new mortgage without having to sell your house from a debt to income perspective. DTI drop. Now, what if your equity is tied up in your new mortgage? That means that, yeah, that's great, Ken. You can qualify me with the DTI drop, but what about my assets? Where am I going to get the down payment, the non-recurring closing costs, and the prepaids from? Well, we call that the equity unlock. Now, what we're going to do is depending on how much equity you have in your house, we're going to be able to release some of that equity so that you can use it for down payment and closing costs on the new house. Now, you may be putting 5% down when you really wanted to put 15% down, depending on how much equity we can unlock. But there's ways for us to take the proceeds from the sale after you sell and do what's called a recast on the new mortgage and re-amortize your payment so that it's as if you put the 15% down to begin with. It's a phenomenal program. There is a QR code on the screen right now. Tom, yes. If you scan that QR code, you'll actually be able to schedule an appointment with me to discuss this in a little bit more detail. There are costs associated with the buy before you sell program, but a lot of times the cost associated with the program may be less than the cost of doing business otherwise. Meaning, if you have a house to sell, you might have to price it to sell aggressively. If you have a house to buy and you have a home sale contingency, you may have to offer a much higher price to stay competitive, knowing that you have a home sale contingency. So it's a phenomenal program. I just want to take a few minutes to chat about that. So far, does anybody have any questions? What is the cost? The cost, it depends. If they're doing the DTI drop, it's 1% of what you eventually sell the house for. If you're doing the equity unlock, that's another 1.5% for the assets for the bridge loan. Now, there are bridge loans out there too, where you can get temporary financing on the house that you're selling that will give you the assets to put down on the new house. But most of those bridge loans are still going to require that you qualify carrying both. So that's not an ultimate solution in some cases. But yes, there are bridge loans. So what does the pre-approval process look like? Well, for one, okay, we're going to sit down and we're going to have what we call a strategy call. Okay. Now, there's a couple different. I use the term intro call and reco call, recommendation call. Okay. Now, the intro call, in fact, I might even see. I don't know if I can change that now, but I'm going to go back on my next webinar. You're going to see that that's changed. Make a note. What's an intro call? Intro call is high level. Okay. Intro call is, where are you looking to buy? How much do you have set aside? What do you do for a living? I might even ask that question. Have you been through the pre-approval process before? Who are you working with as an agent? What's your timeline? In a perfect world, if you had a magic wand, when do you see yourself moving into your new home? These are just questions for me to really get a feel for what we're trying to accomplish. Then we're going to send over our pre-approval application. We have a fantastic pre-approval application, super easy to use. There's a little bit of AI built into it to make it a little conversational and really help navigate the process with very, very little friction. We love our pre-approval application. Now, once we have that information, we're going to gather up your W-2s, your 222, 2 pay stubs, 2 W-2s, 2 bank statements, and we're going to put together a file. We're going to schedule what I call the recommendation call, or in here, it might be called the document review. In that recommendation call, we're going to go over your credit score. We're going to go over your debt to income ratio. We're going to go over your assets. We're going to go over which program we think is going to work best for you. Now, first-time buyers will have the option in some cases to apply for subsidized programs or state bond programs, which potentially could give you up to 5% of the sale price towards your down payment and settlement costs. Well, that would be pretty amazing. And then we finish up the pre-approval and we get into this mortgage calculator. So I'm going to share this mortgage calculator with you for a moment. This is the calculator that we provide to our borrowers once they're pre-approved, and it's custom built for you. This is not like anything else you're going to find on the internet, Zillow, Realtor.com, or any real estate agent's website, where those calculators are generic. They're not going to be able to run real, confident, quality numbers on the house you're looking to buy. But this is going to be built by us for you so you can trust it. So let's say we're looking at a house that's, 400,000 was in there, okay? And on that 400,000, we want to put 10% down. Well, in this case, 10% down is going to be $40,000, which means that you're going to be borrowing $360,000. Now, in this house, the taxes are $8,400, and we're going to guess homeowners insurance. Homeowners insurance is a little bit of a guess till we get closer, or once you're pre-approved, you can reach out to your insurance agent and see if they can give you a quote or an estimate of what they think the homeowners insurance is going to be. So we're going to use 1,800 for now. Okay. So $360,000 loan amount, taxes of $840, and $1,800 for homeowners insurance. When you scroll down, you're going to be able to see a breakdown of what your monthly payment would be on that particular property. So in this case, it would be $33.91. Now, as long as that number plus your other debts does not exceed 45% of your gross monthly income, then you know you're going to be in good shape. Okay. Now, let's say like, that number's a little bit low, I think, or a little bit high. I think I might want to put a little more money down. Well, let's hit 15%. Now you can see that your monthly payment comes down. And so does your mortgage insurance. Let's say you're like, you know what, we're going to be walking away with a lot of money, or we're able to unlock a lot of our equity from the purchase or from the other house. We can put 20% down. Now you see the payment drops to $28.99. But that's not all the information you get here. Not only do you get to see what your monthly payment's going to be, you can also, if you have an association fee, how's that going to impact your total monthly payment? Seller's concession. Seller's assist is money that the seller can give you towards your down payment and settlement costs. I'll be the first to tell you, in this market, in most of Pennsylvania, Delaware, New Jersey, seller assist is not that common right now because it's very competitive. And if you're asking or need seller's assist, your offer is not going to stand up as well. Now, in some cases, though, you might be able to get it, right? So maybe the seller is willing to give you a couple $1,000s towards closing. Drop that number in there. And what that does, now that's going to tell you what your cash to close is going to be. Remember, your cash to close is made up of your down payment, your non-recurring closing costs, and your prepaids. So hopefully everybody can see this. Can everybody see this? I can make it bigger, I think. You know what? Let me just do this. Can I make this bigger? All right. Hopefully that's a little better. I'm a little smaller. This is a little bigger, but at least you're going to be able to see it. So your non-recurring closing costs are going to be $10,900. In this case, your prepaids are going to be $12,180, and you get a $3,000 seller assist. Your total cash to close is going to be $6,082. That's going to be an accurate number, accurate enough for you to make a good decision. Okay. There might be some variances in there, maybe differences in homeowners insurance, or, maybe some title company charges are a little different than what I'm estimating. But the reality is that number will be close enough for you to make a confident decision. Now, let's say your numbers work. You're like, hey, this looks like it might work. Well, from there, you hit a button and a fresh pre-approval letter populates right to your phone. Oh, it looks like I've been logged out, so it's not going to let me. Hold on, let me go back. This is live TV, folks. I'm going to log back in here. Any questions while I'm doing this? No. Okay, thank you. All right, let's go back to this one's Bob Bauer. And the pin is 5296. And we're back into Bob the Borrower. And we're back into the $400,000 purchase price. And we're going to do 10% down. And away we go. Okay? You hit that button, and a fresh pre-approval letter populates right to your phone that you can then submit to your real estate agent so you can put your offer in. Super duper convenient. Now, if you do the fully underwritten pre-approval, this will actually automatically, once we have the fully underwritten pre-approval, this will become a TBD commitment, and that's going to allow you to put in a much stronger offer. Okay, let's go back here, back to our calculator. Okay, now let's say You are looking at a house and it's 700,000. And let's say you want to put down 500,000. I'm just putting in some crazy numbers here for a reason. Okay. Let me go 1.8 million, 18 million. And we want to put 20% down. Okay. What's going to happen is this has guardrails built into it, meaning that if you run numbers and you don't qualify, you're going to see that instead of a pre-approval button, you're going to see monthly payment too high or cash to close too high. In this case, the monthly payment would be too high, and of course, the cash to close would be too high. And I don't have to get that crazy to come up with these numbers, but I just wanted to give you a quick scenario of what it might look like if you ran numbers on a house you didn't qualify for. These guardrails will be built in. This is probably some of the best feedback we've gotten over the last year and a half since we introduced it. People love this calculator, and it's a great way for them to run numbers and see. And it could be a little bit of a double-edged sword, I'll be honest, because you're out there looking at houses, or you're looking online, or looking at your agent. It can be a little addictive. That's all I'm saying. That's all I'm saying. All right. So that's your pre-approval. Now you get out there, you do the home search, you're using your pre-approval calculator tool, you put your offer in. You put your offer in without the home sale contingency. You put your offer in with a quick close. You put your offer in with a fully underwritten pre-approval. You put your offer in with a phone call to the listing agent from your loan officer. Guess what? You have a really, really good shot at getting that offer accepted, and it's going to be irresistible to the seller. And then you set up your contract to close. At that point, you'll be introduced to the rest of my team. We'll work with Andrew, Stacy, and they'll be gathering up the remaining documentation to get your file underwritten and prepare your file for closing. Update any documentation that needs to be updated. So what do you do now? What do you do now? Well, you have a couple options. One is obviously do nothing. Okay. If we do nothing, rent keeps going up, or lived in the basement, gets more and more frustrating. And keep in mind, this is one of my favorite. It's really hit me hard before I bought my first house. You're going to be paying a mortgage. You're just paying your mortgage, or you're paying your landlord's mortgage. Which one do you prefer? All right. So every month you're paying someone else's mortgage. Prices don't wait. People that were waiting in 2023 for prices to come down, they haven't come down. 2024, prices come down, haven't come down. 2025, 2026, on and on it goes. Okay. There's nothing on the horizon that I see that's going to drive down prices in a meaningful way other than massive unemployment. And let's hope that doesn't happen, obviously, in some cases. But the reality is you really can't time the market. Okay. You can't buy today's house at yesterday's prices. Rates can shift. We've seen that over the last 18 months. Rates go up, go down. They've been as high as 7 1/8. They've been as low as 6% over the last 18 months. And that shift can really change your ability to borrow. And of course, life stays on hold. The stability, the control, the security you want, it doesn't show up until you make the move. Action is the answer. So how do you do that? Well, know where you stand. Know your numbers, know your credit, and know how much you'll need. Know where you want to go, where you can shop with confidence. Know what work still needs to be done. Sometimes the pre-approval application ends with not a pre-approval letter, but with me giving you a plan that's going to put you in the right place to perform 90 days from now or 180 days from now. It's not always ending in a pre-approval. How do you get there? Well, you need that roadmap, and you need to make sure that your offers are irresistible, and that's how you build the life that you want. It's about the plan, right? The right plan changes it from an emotional perspective to a logical perspective, something you can execute. So instead of guessing, reacting, shopping emotionally, or finding problems late, confident, you with a plan, you're confident, you have clean documentation, stronger offer, and a much calmer closing. Our closings are really, really cool. Instead of it being like the end of a cold, lonely journey, It really is a celebration, and that's what it should be. Okay. So, as I've said before, proper preparation prevents problems. That's what the pre approval is all about. It's not about stress. It's not about pressure. It's not about sales tactics. It's not about getting you to do something that you don't want to do, right? It's just about preparation. It's about making sure you're prepared to take the next step, whatever the next step happens to be. Now, again, that QR code will get you my contact information where you're going to be able to fill out an online mortgage application. You'll be able to schedule an intro call with me, and we can go over your situation. Any questions now? I know Bob had a question earlier. State bond. Yes, first time buyer programs. Thank you. We do have programs. One is called the PHFA K-Fit, where if you look at, I'll bring the calculator back on the screen. Okay. I wonder if there's a way for me to actually convert the calculator while we're in here. Update pre-approval. This is how easy it is. Next. Check the cake. Let me see if this updated, and I want to refresh here. Should be a new box. Oh, here it is. Sorry for the downtime. This will be edited out, I'm sure, in the next edit. Update, is it there? All right, doesn't look like it is saving in here, but that's okay. So in this case, you would basically be eligible for up to 5% of the sale price in an interest-free second mortgage. No interest, no payments. And it's forgiven over a 10-year period. So if in this case, 5% is $20,000, if you're putting 5% down on a $400,000 property, your total cash to close would be $43,137. But you'd have the ability to get a $20,000 interest-free second mortgage that's forgiven over a 10-year period with no interest and no payments. And that's going to drop your cash to close down to $23,000. So from $43,000 to $23,000. This program actually allows you to put as little as 3% down, in which case your closing costs and your down payment would be even lower. This particular calculator, again, it's custom built. It's not built out for a PHFA, but if you qualify for a PHFA, your calculator will be built out. And you could get into a house with a $400,000 house with as little as, $18,000 in some cases. So thank you for that question. Yes, PHFA K-Fit is a great program for first-time buyers. Any other questions? Joe? No? All right. That's our presentation for you this evening. I hope you found it informational. If you want to reach out, again, you can reach out to us. Here's the QR code. Schedule a call. We'll get you going in the right direction. And again, proper preparation prevents problems. I'm Ken Jordan. I'm looking forward to working with you. Have a great night.